Meantime, one of the Fed's voting members next year is out with some new comments on the economy. Let's get to Steve Leisman with those headlines. Steve.
And important ones. Atlanta Fed President Raphael Bostic becoming among the first Fed officials to say outright he believes the current Fed interest rate is, quote, sufficiently restrictive. That's the benchmark forged by Fed Chair Jay Powell to determine if the Fed can stop and hold rates at current levels. I'm very much in a place, he told reporters earlier today, where I think our policy is sufficiently restrictive and that we can be patient. Fed Vice Chair for Banking Supervision Michael Barr yesterday said the Fed is at or near that level, suggesting he's close to Bostic's view, but not quite as definitive. Bostic's comment could mark him as an outlier on the board, with several Fed officials recently suggesting that they would favor an additional hike, and 12 of 19 members actually forecasting one more hike this year. In fact, the probability of a final hike this year rising this morning to 31% for November, 47% for December, after a strong job openings report implying continued strength in the labor market. In any event, Bostic suggesting the Fed shouldn't hike again doesn't offer much relief out there, because he went on to say the Fed should hold rates at current levels, quote, for a long time and well into 2024. Asked about surging long-term bond yields with the 10-year, as Dom just said, hitting new 16-year highs of 475. Where are we now? 478 now. If I blink, I get it wrong. He said higher rates will help the Fed restrain the economy, with corporate debt refinancing a potential drag, helping slow growth and bring down inflation. He added he doesn't believe that companies were really being severely impacted by higher rates now, and that his main focus is on the consumer. He said a soft landing within reach, but the Fed has to monitor carefully the slowing of the economy. The next rate hike, Bostic says, the next rate move, Bostic says, the end of next year, 1/4 point cut.
It's still significant. We've seen him kind of approach this thinking, but this is the first time he's come out and said it.
And I think what you have is you have those on the committee who are worried about lags and those who are not.
Right.
One of the lags, he points out, is the corporate debt refinancing. He says another shoe to drop in the economy.
Very interesting. All right, Steve, stay right there with Treasury sitting at decade highs.